Welcome to the Canadian Investors Course, Session 15, Rules-Based Investing. Building a portfolio by bringing together fundamental and technical analysis. Slide 2, Terms of Use and Disclaimer. We read this slide to you in full in the introduction. Please read it again. Wall Street. Always coming up with ideas. Buy, sell, hold, jump. Let's get our perspective straight. There are many versions of rules-based investing. Just because you're told that a rules-based technique is being employed, it doesn't mean that it's this form of rules-based investing. We advocate that advisors should investigate other versions of rules-based investing solutions, with the exception of the buy and hold static portfolio. We believe that investors should buy and hold a set of rules, as in a discipline. In other words, buy and rule, not buy and hold a rigid set of pie chart portfolios, refer to the previous lessons, with most likely the 30-year bull market in bonds or falling interest rate environment coming to an end. The era of buy and hold is probably in question. Although there is the argument that over a multi-decade period, markets recover and go to new highs, and this has been the case over long periods of time, investors may not have a long enough investment horizon to wait. This course's version of rules-based investing is not focused on constantly outperforming the underlying markets that you're investing in. It's focused on long-term growth using fundamental and technical analysis to minimize losses that can occur, especially in bear markets. We don't want to participate for 2 to 5 years in a growing market just to have a major part of our growth taken away in a bear market, when spending the next 2 to 4 years is going to be what it's going to take just to get back to par. That's a stressful event that most investors can't stomach. And one of the painful things about the markets is that when they decide to correct, they tend to correct much faster than they went up. So, getting started on rules-based investing. First of all, create that personalized investment policy statement, the IPS, referred to in Session 13. An IROC advisor should always create an IPS similar to this. Your IROC investment advisor, along with yourself, should determine what your current asset allocation mix will be based on A, the fundamental conditions of the economy and valuations of the markets themselves relative to historic norms. B, technical analysis, which indicates the market trends. C, fundamental and technical analysis together to determine individual security selection and investment into the portfolio based on asset allocation chosen. In other words, the percentage of cash, fixed income, and equities. D, monitor market indicators and be prepared to shift security allocation ranges accordingly. This is important work and is crucial to a safety approach to investing. Note steps A through D are constantly repeated, whether it be weekly, monthly, quarterly. This is your IROC investment advisor working for you. Rules-based investing, an example. Investors John and Ingrid Doe, both age 55, portfolio size $500,000 joint account. After a financial plan and risk tolerance analysis, the advisor presents this IPS to John and Ingrid. Cash, minimum 10%, maximum 60%. Fixed income, minimum 20%, maximum 60%. Equities, minimum 20%, maximum 70%. These are strict guidelines for managing a portfolio for this couple. Yours may be different. Don't copy these. You need to determine what is right for you. Please note that these guidelines will change as time passes. Rules-based investing, an example. Please refer to Session 1, 2, and 4 as appropriate. These sessions deal with the introductions to income and equity definitions and equity selection. The example begins with understanding security selection, which bonds, stocks, etc. should be held within the portfolio. The different types of ratio analysis that will be used to find a fundamental value stock. Market and/or economic conditions, as well as technical analysis, will determine the critical tactical asset allocation range in the portfolio. This range must lie within the restricted strategic established range. Please refer back to the Joe and Ingrid strategic range. The CIC course was designed to help investors understand the various types of security analysis. This is not a portfolio manager or security analyst course, which require many courses and years of experience. Most IROC licensed advisors will have access to this research and can create a complete list of portfolios, including track records. So let's pick an example for rules-based investing. Below is one form of technical analysis that an IROC advisor has access to. These are the crosses. By that we mean the crosses of moving averages. Moving averages are the rolling moving average of prices in the stock market, picked with different periods of time. So typically when you're looking at a cross, you're looking at a short-term moving average, a longer-term moving average, and you're monitoring the crosses. In other words, when one of those moving averages crosses the other one. The 1930s Dow Index chart below shows two moving averages, the green line and the red line. The investor sells when the green line crosses below the red line and buys when the green line crosses above the red line. Obviously here, the red line is the longer-term moving average, the green line is the shorter-term moving average. Note that it can take a long time before you change allocations. Sometimes it can occur twice in a year. The market itself triggers the changes. No one knows when they'll occur. You have to pay attention to them. When they occur, that's when you have to do something. So let's look at all the decades returns since 1929. You can see that in Session 4. Take the time to look back at that. You'll be impressed at how well it works. So just as a reminder, let's look at the Dow Jones Index from 1929 to 1940. You can see that in 1929, the green line, the short-term average, crossed the red line in an important way. And in fact, it stayed below the line all the way till 1932. That means that if you sold in 1929, you had to stay out of the market until 1932. But in 1932, it gave you a very important cross again. And if you were following this system, you would have bought the market again in 1932. You would have also sold it in 1933 and bought it back almost immediately afterwards. You would have sold it again in 1937 and bought it back in 1938, and so on and so on. In other words, you would have protected yourself against a huge drop, and in the other times, it would have been more fine-tuning. So the important thing is that if you look at this example, instead of losing 60% of your money, you would have ended up with a 6% return over that period of time. If you had been a buy and hold investor and you had bought in 1929 and held on through the course, it would have taken you until 1954, 25 years to break even. This is the most powerful example that you can find in history of how this rules-based investing strategy can be so helpful. However, if you extrapolate it across the whole time period, you'll see that it worked effectively. Go back to Session 4 if you need clarification on that. Now, let's look at how it worked for the bond market. Let's take 2007 to 17. 2007, the bond market prices were at, the yields were up at 4.5% to 5%. Today, the yields are bouncing off of 1.5% to 2.5%. And look at how the crosses worked so effectively. If the 10-year government yields were caused the green line to cross the red line, then the allocation would drop 20%. In fact, this did occur in November 2016, but bonds still remain to sell. 10 to 20-year bonds have lost 10% since February 2017, and there may be a time when Joe and Ingrid will hold 60% cash or money market in the portfolio if the crosses indicate that they should. So Rules-based investing continued. Maintaining a portfolio of no more than 30 stocks prevents index effect described in Session 13. Can an advisor use an investment tool to limit downside risk? You bet. Use a technique that an IROC advisor has easy access to, namely the stop loss order. When you buy a stock, put a stop loss in it. If you're wrong, it's going to punch you out, and you're not going to have to follow it all the way to the bottom. Ask your current advisor if they can place stop loss orders on your investments. This can't be done in all markets, but in some markets it can, so where you can use it, it's a useful tool, including any mutual funds you hold. You'll soon discover whether you have a true full service IROC advisor or not. So let's look at stop losses a little bit more. When buying a stock for the portfolio, you can place a stop loss for US stocks and a trailing stop loss for Canadian stocks. You can do it automatically. These are usually placed for no more than 1 month, sometimes up to 60 days, and the advisor can renew or review the stop loss at maturity. If you buy a stock for $50 a share, you can place, for example, a 1 month $45 stop loss order that will limit your downside. If you get stopped out or sold out on a fall to $45, you can decide whether the stock should be repurchased or not. This is a very conservative strategy. It prevents stocks in your portfolio from falling 30 to 60%, and then you're told to hang on in there. The stop loss technique helps alleviate these problems. If investors only need to be successful 60% in stocks, they invest in to do well, but it would be wise to limit the downside of another 40%. If the stock price goes higher, they don't get stopped out. Rules-based investing includes the usage of this stop loss practice. Use this technique illustrates how valuable a full-service advisor can be within a fee-based investment account. Please refer to Session 9, the investment industry and fees, to understand how the IROC advisor compares to the rest of the industry. So, summary of rules-based investing. 1. Create a financial plan, preferable but not totally essential to the IPS formation. It is essential to your financial health, however. Complete the investor's risk tolerance assessment, so know what your risk comfort level is. Calculate the required risk to achieve the rate of return goal for the portfolio. Don't take more risk than you need to. Construct an IPS. Have strategic allocation ranges, as per the Ingrid and John for cash, fixed income, and equity. Based on fundamental technical and economic analysis, determine a tactical allocation within a restricted range. Determine which percentage of cash, fixed income, and equity to make up the investment portfolio. Create the investment portfolio with securities selected through analysis. When purchasing individual stocks or ETFs, place stop losses, 5%, 7%, or 10% on each security to avoid further downside risk. This is work, but no problem for the IROC advisor to monitor. Monitor and repeat Step 5 and Step 7 repeatedly, and then review the IPS allocation restrictions on an annual basis. That's the end of Session 15. That was a big session. You may have to go through that again. Make sure you understand all the details. If you need any clarification, perfect opportunity to talk to your advisor. If you're not getting the right answers from your advisors, go to the locator on the website and look up a trusted wealth professional. And maybe it's time for a new relationship. Thank you for listening.